Hello, 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 everyone. Welcome, welcome, welcome. We are so excited to have Mike Daley here today. And before he gets started, just wanted to tell you that we've started a new mastermind. It's called the Investment Risk Advisor, where I teach people how to do their due diligence before they do any of their investments so they don't step into any holes. And then we also review all the investments that you who have joined the mastermind are interested in making sure that it works to grow your portfolio. And I started this because I have received, I can't tell you, probably 100 or so emails from people or phone calls saying, what do we do? What do we do? Like, well, you show me stuff before you make the investment. Don't call me after you make the mistake. So, that. And I have, I like to pick out a nice quote for whoever's coming on and performing. So this I picked for Mike because he's CPA. He's been in the CPA business, tax advising business for quite some time, about as long as I've been in the real estate world. So money sent forth, returns multiplied. Isn't that what we want with our tax advantages we get? And John Wooden said, you can't live a perfect day without doing something for someone who will never be able to repay you. I just love that. John Wooden was such a nice person. So Mike, welcome, welcome, welcome. I've known Mike for quite some time, and he and I met. We were in Bob Allen's Platinum Inner Circle. That's where we met. Oh, I don't know, 10 or so years ago. And we just stayed in touch all these years. And with Bob also. And I know that you did a few things with Bob and traveled with him and all. But Mike Daley began his career as a union groceryman in 1973 and transitioned to tax work in 1979. He graduated cum laude from UC Berkeley Business School in 1980 with a focus on accounting and applied economics. Mike earned his CPA license, started with Arthur Anderson in San Francisco, and then becoming a senior tax accountant, working with corporate and individual clients, including Levi Strauss, handling industries like manufacturing, shipping, agriculture, and film. Mike became a corporate tax manager for a PC software company, a precursor to Microsoft. Oops. And he explored personal growth programs such as Tony Robbins, Walk It on the Coals, Yay, and Marshall Thurber, his entrepreneur course. Although Mike is currently inactive, he ran his own practice focusing on family business accounting and financial planning. He's also a chartered financial consultant. We are so thrilled to have Mike with us today, talking about the importance of having a tax strategist on your team. So thank you, Mike, so much for being here, and please take it away.
Very good. Thank you, Peggy. Thank you very much for inviting me. I have a little more precision on my counting. So I was in Korea with my wife visiting her family in 2016. I got an email from um, Steve Love in LA that Robert G. Allen was going to form this private inner circle mentoring group for a year. And I immediately responded, thinking it was an amazing opportunity. And we were in that group together, met in Los Angeles. And I know you're a lifetime learner. You didn't ever stop and been a real estate investor and an educator for quite some time. So Robert G. Allen, amazing guy, global speaker, New York Times best-selling author. He wrote the book Nothing Down and half a dozen or a dozen other titles, right? And in 2017, I turned 60 and Robert was going to Japan to talk to a multi-level organization he built there. And he and I climbed Mount Fuji together. They say a wise man does it once, a fool does it twice. So jump into sharing my deck. And let's see where here. On the wrong slide. Let me go back. A little delay. There we go. So if you hear it, listen about how to pick a CPA and why, you're on the right call. We'll talk about the components that are typically handled or might not be handled. Most people think about getting their tax return done. In the business, we call that compliance. It's putting numbers in the boxes. It's the first step. Tax planning is an important element, particularly when you get into the investment realm. And tax strategy is often missed. That's a multi-year approach where you understand your transition from earning to retirement, from saving to investing, and not just getting involved, but getting out the back end. One example where uh, years and years ago, a gentleman I worked with had refinanced his property and basically taken the cash out. And then when he sold it, there was a big tax bill that he was not expecting, and there was no cash out of the sale because the loan had to be repaid. So options, people do it yourself, DIY. There's free software if you don't make very much money. And referrals, I'll talk a bit about that off and on. Um, After that, we talk about the different levels. So there are CPAs. California has a certified tax preparer called CTEC, enrolled agent. I'll mention that later. Tax attorneys. And then a lot of other people will talk to you about taxes, including family and friends, Google, Instagram, Facebook, even TikTok. So what's in it for the listener? Be an informed consumer, figure out what to research, how to survey, how to interview, what to assess, and how to make your selection on a 360-degree view. Be in charge of your business and investment portfolios, including the tax angle, because as we'll see, tax touches every dollar that you earn, save, invest, give away, donate, or pass to your family or charity. So I want to talk about having a strategic overview, and I want to kind of frame it like that to zoom out from how the ordinary consumer thinks about the tax man or the tax lady. So know what you want and how to get it, and get the satisfaction with the services that you seek and that you pay for, and get the results you want. You talk to people about their tax person, and some of them have a raging love that goes on for decades, and some have a disgruntled. I worked with a CPA friend of mine many years, and he said, once a client's been with you for a while, they begin to identify you as the IRS and the enemy, and the relationship gets rocky. I don't know if that's always true. I'm no longer doing tax preparation compliance, and I'll talk more about that as we go forward. Uh, why listen to me? I don't know. You're on the call. You have your reasons. I did the certified public accountant since 1983. I was fortunate in college to have enough coursework to get through the exam one time, all parts, 2.5 days. And license has been active or inactive, but in 2017, I decided to leave it inactive. I did a stint in the insurance business. The Chartered Financial Consultant designation was awarded from the American College. It's basically, think of, what do they call, CFPs, Certified Financial Planner. It's a pretty tough exam. chartered financial consultant, was 10 courses. But I've always been tax centric, even 15 years doing accounting systems. Um, Below is a graph, federal revenue by type. This goes back to the founding of our nation. You can see only excise taxes in yellow were the source of revenue for the feds. Income tax got introduced around 1913. And today, income tax and payroll taxes are 25% of our federal revenue, if I'm reading the graph. Just threw it in there for color and visual. So again, what's in it for you? Be informed, be in charge, be more knowledgeable, in depth, know what the nooks and crannies are in the tax game. So know what you want and how to get it. Oops, let's see. Do, do. All right, why care about tax? As I said, it touches every dollar that you save, spend, give away, whether it's a gift or a donation of a charitable nature, every dollar you earn. And when it's all said and done and this life is finished, what you've accumulated either goes to Uncle Sam, your family, or another cause you care about. And I won't go into details about that, but it's just a holistic overview. I look at tax in the palm of your hand and it touches every finger. The most important one is probably family, because we all had a family, we have a family, we may have our family of origin, and we may have family that have joined us, during our lifetime, people that we care deeply about. Individual income tax, marginal tax rates. Marginal means what is the tax on the next dollar you gain? And I'll get wonky for a second. My favorite Internal Revenue Code section is 61. It says everything that comes into your hand is income unless it's taxable income, unless there's some specific provision in the thousands of pages that would exempt it. So currently, if you look to the far right, tax rate is 37% on the top dollar for top earners. You look back in history, it's been as high as 90% up until about 1960. And we dropped to 70%. And you'll see there was a dip with Ronald Reagan's second term where it went down to 28%. That's roughly 1985, 86, Tax Reform Act of 1986. So more about me, 2015 to current, I'm focused on families with significant assets. We call them ultra high net worth. Over 30 million seems to be the common dividing point. Below that, you just have high net worth. And family office is a new buzzword you'll hear a lot. It's basically a term for rich folks with a need to hire in-house talent, employ them full-time. Multifamily office is a new concept whereby affluent folks need a part-time expertise in certain areas, whether it be investment management, bookkeeping, bill paying, financial reporting. I did financial reporting on a global basis from 99 to 2014, mostly around the Oracle software and Road Warrior. I'll show in a moment some of the companies I was fortunate to be involved in, some pretty interesting businesses, and to see them, as we say, there's two things the public should never see: how sausage is made and how financial statements are made. And they're both a bloody mess. The first thing I learned out of college was the answers don't come out to an exact, correct answer. There's a bit of art in the science. 88 to 98, I worked in the insurance business doing retirement investments, group insurance, things we call private pension, using life insurance, disability, and health with the Equitable. So over 40 years, I've been trying to get my left brain and my right brain in concert, in harmony. I met Tony Robbins in the early 80s, Marshall Thurber the same time. Actually, he introduced me. Went to an event in Aspen, Colorado called the Future of Business. And the night we arrived, they had big bonfires, and Tony Robbins was the featured speaker the first night. And they pushed out those coals and took off our shoes. And I think the title of his course is called Fear into Power. So these are some of the companies I've had the fortune to work with. Some you recognize, some you may not. A lot of smaller companies, dozens more. Some of them were tax clients and some of them were accounting systems. How long have I been in the game now? Well, since 1979. I got out of school in 1980, joined Arthur Andersen, the Economic Recovery Tax Act. The main thing to notice on this slide is that word in the big letters says Roth, R-O-T-H. So for about the last 15 years, I've been a student of the real estate game. And over, the really smart guys help build a big fat Roth. And I'll talk a little bit about that later. Why do that? And it's kind of a get rich slow scheme in the beginning. My wife and I have been putting our maximum IRA contributions into a traditional IRA because we might be prohibited from making it directly to the Roth. But there's something called a backdoor Roth where you can move the money from a traditional IRA over to the Roth. Big deal, Tax Reform Act of 1986. I mentioned Reagan's second term where their top tax rate dropped big time. But they also introduced passive real estate loss limitations, or PALs. And PIG stands for passive income generators. Go into that a little bit more later. AMT, alternative minimum tax, is a strange and mysterious thing that's come in and out. And if you've been in a high income tax bracket you may have some familiarity with this topic. Now you'll notice in the second half of the slide, new millennium tax cuts. There's a lot of them since the 21st century. The Secure Act and the Secure Act 2.0 have made some important changes, some of which may affect you now, some which may affect you in the future or your heirs. 2017 was Donald Trump's Tax Cuts and Jobs Act. And as most of us know, even the most consumers know, big changes came in. Corporate tax rate got dropped for domestic companies. There was an attempt made to move offshore profits of American companies back into our revenue stream. I haven't studied the Inflation Reduction Act a great deal, but it has some legs to it. It's a 10-year plan. The 2017 Tax Act had some provisions that were set to expire, but we can expect with the new administration that those changes will be extended. So I'll get to it, how to pick a CPA and why. Research it, survey it, interview it, assess it, select it. Google your geography. Ask for referrals. They're helpful, but you have to do your due diligence. You have to check out who's a good CPA for your brother-in-law might not be the right one for you. There's 3 parts. Have them in mind when you have this conversation with yourself and your spouse and your family. Compliance is getting the tax returns filed timely, tax planning. I find a lot of practitioners are so consumed with preparation that their ability to do tax planning with you on a comprehensive basis, to zoom out and understand where you're at in your life, what your finances are like, what you have in your balance sheet today, and where you want to go, is not necessarily something that's in the wheelhouse of the majority of practitioners in my experience. Now, I've worked for big firms, I've worked for small firms. In the insurance business, I was brought into that because insurance has some great tax advantages, but they're not for everybody. So, other options, you can do it yourself. I dream of the day when I can give my box of stuff and have somebody else prepare my return. Hopefully, not too far in the future. I mentioned CTEC. I think this is important because one very, very key thing that's not on any slide that I want to make very clear is that people are not going into the profession. There's a shortage of talented tax advisors and tax preparers. CPAs are retiring, they're dying, and smaller ones don't necessarily have a carry forward plan. I helped a family out last year. The husband was a CPA on his own for many, many decades, and he basically sent a letter out to the clients that I won't be able to help you this year. Please go find other help. So not every preparer has a succession plan to get out of their own practice. EA, enrolled agent, it's a pretty significant hurdle to jump and get qualified. And I don't want to call them that they're an alternative to a CPA. They're typically highly qualified, and they have rights to represent taxpayers with the IRS for any issues, collections, audits, even tax court. Tax attorneys might be overkill for some, but might be the right choice for you. Insurance agents, financial planners, investment advisors are all going to be conversant in some respects about taxes. But like family and friends, like Google and social media, you're going to not get the whole story that applies to your specific circumstances. Very, very important to know what your circumstances are and which bells and whistles you wish to ring, right? So referrals, I talked to two people. I was going to do this talk, and the first guy said, "Oh, well, you picked the low cost option. That's the right answer." And I'm like, "Nah, wrong, Matt. Thank you for playing." And Matt is a very sophisticated financial guy, okay? But that just goes to show expert in one area of money doesn't make you all that. Today, I met a woman at this conference and she said referrals. And I won't discount, but one thing I learned in sales is who's making the referral? How strong are they? And on what basis are they making the referral? Oh, I've been using them for years. It's fine. They're cheap. Okay, that might not be the best criteria. So do some survey. And here's questions that might matter most to you. These are the things that I would think to ask about a business that is providing tax services, particularly compliance. What is the size of the practice? How many returns per year? I spent some time with a local CPA who does 3,000 tax returns per year. Now, he has a staff of 20 and they get the work done and they're competent, but his special clients can only be a few dozen. The rest of them, he's going to give it a once over. He's going to farm it out to his two key lieutenants. If you need trusts, if you have a trust that requires its own tax return, Form 1041, do they have skills here? Do they do any? Do they do not-for-profit work? Some CPAs specialize if you have a 501c3. Then there's business returns. These are partnerships, S Corps, C Corps. And lastly, gift and estate tax returns. You can make annual gifts without a report up to a limit, come somewhere in the 18,000 a year. And if you're married, you can give away 36,000 a year to an individual and give this 36 to their spouse. And these are under the threshold, and they don't count against your lifetime giving, which goes into an estate tax return. Currently, you can leave an estate under 12 million without death tax. Before 2017, that number was in the 5 million range. Passing to a spouse is another conversation altogether. How many years of experience does this preparer have? And if it's a firm, is there one senior partner and a couple juniors? And what kind of experience? Drill down. Understand, do they do mostly business? Do they do mostly individuals? How many partners? What are their qualifications, their certifications? Where are their specialties? And I think most importantly is number 4. How much focus do they have in the real estate business? Are they personally experienced as investors? You find probably a smaller percentage of tax people are experienced real estate investors themselves. But if they have other client profiles, if some of their key clients are in the same world as you, they might be a good match. You want to know about the number of staff, how many in-house. A lot of them use contractors for busy season. There's peaks and valleys in the tax business. And offshore is another model that's being used. I've done it myself. Goes back more than 15 years ago. We'd input documents overnight to India, and we would get back a draft tax return in the morning with work papers, and it was about $35 at the time. So there's now a special form. If your preparer is using this service, they need to disclose it, and you need to authorize your tax data being shared offshore. Then, of course, really last and least important is the price range. Some have a minimum. I heard H&R Block's at 600 already. I have friends, husband and wife team, they're up to 1,000 as a minimum, or they were at 1,000 minimum a few years ago. Look at hourly rates, but unlike Matt, I would not make your decision based on the low cost provider. What you pay for is what you get. So don't be shy. I had a conversation a few weeks ago with a lady who pays her CPA in San Jose $200 a year for her tax return. My recommendation is send him a $400 Christmas gift every year. Here's a few tax topics. If you're in the passive real estate environment, things you want to know about, you probably already know about. Tax-free exchanges, very cool thing to do if you're in real estate. In fact, real estate is the only remaining asset class that permits tax-free exchange under Section 1031. Great things about real estate. Depreciation. This is writing off the cost of your property over time. If it's residential, 27 years, commercial, 40 years, 39 and a half. Remember, though, that this does not include the land. So an allocation needs to be made when you first purchase the property on your first tax return, how you're going to split the purchase price between land and improvements, being the structures. Cost segregation is a very popular topic these days. And what that's about is if you bought, say, an office building, you may want to identify those components of the building that could be taking advantage of faster write-offs. Anything that's not a permanent attachment to the building qualifies. And there's some very creative stuff in here. I won't go crazy on the details right now. Bonus depreciation has come and gone and it's back. And typically for personal property, you can find a 100% write-off for business use in the year of purchase. There's limits for cars, there's limits for leasehold improvements, etc. Great thing about real estate is using other people's money, leverage. Even with a passive real estate investment, you might find that the general partner is going to borrow money to purchase the property, and you can benefit from that leverage. It can cut both ways, so there's always a plus and there's always a minus. I mentioned PALs and PIGs, passive loss limitations that came in 1986. If you make enough money, you're limited to $25,000 in losses. In fact, that phases out. You can carry them forward. They can be offset. They can offset any gains in the future. And if you have passive income generators, you can offset those passive income with passive losses. And because of depreciation, depending on how your real estate purchase is structured, you may have tax losses. More important is cash flow. If you're in the real estate game, you would know this, right? Cash flow, but the tax impact also impacts cash flow. More
Are you
active,
close? Yeah. Are you
yep,
close to
about
done?
yes, I'm just about done. I thought these slides had numbers, but not this deck.
It says
Uh,
14.
yeah, I have 3 slides. So I'll just let you read these. I focus on self-directed IRA. They're not offered by banks, brokerage, mutual funds. They require a separate trustee. There's at least a half a dozen competent providers of self-directed IRA. This allows you to do things with your IRA account you couldn't do with a Vanguard, Fidelity, Charles Schwab. But there's very complex rules. If they're a good trustee, they will help you avoid self-dealing and getting in trouble with your IRA. The traditional IRA I mentioned down below, it means IOU, Uncle Sam.
Yeah.
Yes, there's a deferred tax at the back end. People think when I'm retired, my tax rate will be lower. That ain't necessarily so. Um, so consider in a multi-year recharacterizing to a Roth. Real estate professionals.
Hmm. Oh, I think you froze up, Mike.
Looks like he's frozen.
It does. We can't hear him.
Um, Austin is moving.
Yep, we're all moving. We're good. Of course, it'd have to be our speaker, right?
Can you hear me now?
Yes, we can. Thank you.
All right. So a few words about LLCs. It's not a tax entity. It's a legal form of business. The owners are members, and the LLC may elect to be treated as a partnership, which is usually the case. And for limited partnership interests, see Peggy Beauregard at the Nest Egg Builders. For turnkey passive investors, know your general partners and what's their track record.
You bet.
Thank you, Peggy and Dawn,
Oh, thanks to Robert.
Peggy's trusted assistant. Here's a couple quotes from Robert G. Allen. The future you see is the future you get, meaning you got to look, got to have the vision, got to be informed, because it's a tough business if you don't know what you're doing.
No kidding. Thank you very, very much, Mike. Of course, I came up with a few questions, but one of them was, well, one was just, there's about 50 self-directed IRA companies out there that are trustees, so there's quite a few, so always call several of them until you find the one you like. The ones that are really pushing their Roth IRAs are people you want to stick with because they'll help you figure out how to roll your money into, if you're coming from a traditional, uh, roll it into a Roth, and you'll still have to talk to your tax accountant so that you don't go into a higher bracket. So there's a lot of details to do, but pay your taxes before and during while you have your money invested, because they don't necessarily have to have cash to roll into a self-directed Roth from your traditional. They can roll parts. Let's say you did $100,000 multifamily investment. They could roll however you want it. You could roll like 20,000 over 5 years because they're going to sell at the end of 5 years. And when the money comes back, it'll be in your Roth, not in your traditional. So talk to your tax advisor about that and talk to your self-directed IRA company about that.
Yeah, 3 points on that, Peggy. One, be very, very cautious. I listened to a presentation from an insurance provider, annuity provider, real keen on getting even your 401k, pulling it out now, paying tax, getting it into Roth. Be very, very careful. Get more than one point of view before you make a move. And
Always.
one thing about this, you just mentioned something that caused some alarm in my mind because I said, I'm, how did I say it? I'm going to make an investment and then move it to the IRA. And that is the self-dealing idea. You have to be cautious about going in and out of IRAs, whether it's first time or moving to the Roth. Be careful. Make sure you got all the facts. And these if you're going to pick a self-directed, talk to somebody that has some experience with that provider.
Yeah, we've had plenty of, anyway, there's like 50 companies out there. You can't invest in a let's say a single family and then put it into a self-directed IRA. You need to have your money in your IRA already. And then if it happens to be a traditional and you invest in that, then the IRA invests in the single family, let's say, and then you can roll portions of it into your Roth. But you can't buy a property outside a self-directed IRA and then put it into one. They won't do that, but they'll do the other. I've done that many times, move portions over years. And so when you're talking about cost segregation, a lot of the cost segregation is 5 to 7 years deductible and the bonus of 100%, because most of the sponsors, the general team, are only going to hold the property for 5 years. So in 5 years, they've pretty much deducted everything. And that's how the cost seg works for them. I don't know that it's great if you're holding something for 25 or 30 years, but for that, you're getting to deduct everything. So you're getting your K1s are coming in with higher losses. And people get upset when they see the loss. But let me tell you, the loss is good because it's a write-off on paper. It's not an actual, they didn't lose money. They got to write off from their taxes. You have a comment, Chris? Or were you just waving?
Oh, sorry about that. I just putting my head on my head. So
Okay, fine. Oh, you're invested in so many different multifamilies. I thought maybe you had something to add because we love it when you
I
all.
do have one thing to say. Just make
Yes.
sure you call and there's a lot of firms out there that they're like people sitting in their basement and they'll call you back like a week later. So I use the Intrust group and they've been great. I call, they pick up the phone and stuff like that because when we're doing an apartment complex, I usually have to get a bunch of wire transfers for from the self-directed IRA people. And it's been brutal for some of the companies. They don't call you back. I don't know where the people are located, and they'll call you back like a week later, and their wires never hit on time. And so because they only charge like $50 for a year. So I think I pay 300 for the interest group for my self-directed, but it's really good. They pick up the phone. They'll answer
Mhm.
any and all questions. It's just the race to the bottom is not the best when it comes to self-directed. So
It's not, and I've been with several different companies, mostly because the IRS came in and closed them down, or somebody closed them down, and my money's been moved several times without my permission because I didn't get to interview the companies to find out who they are before my money got moved, because I wouldn't have gone with most of them because of just what you said. You don't get a return call. Um, they don't let you talk to the people you need to talk to because I'm only in real estate, and they have a I don't know, receptionist, and the receptionist doesn't understand, and they misinterpret what you're saying, what the question you have, and so you don't get the answers you need. So it's really important to almost the same questions as Mike is giving you for interviewing a tax advisor and knowing
Mhm.
about that. That's just so, so, so important. Mike, I never heard of a enrolled agent before. Can you expand a little on that?
Sure. Yeah. So enrolled agent is highly qualified in the sense that the requirements to be given that license involves education, testing, and that is a federal designation through the Internal Revenue Service.
So they can do your filings for you, your
They can
annual
sign tax
filings?
returns, they can handle correspondence, they can handle audits on your behalf, and they can go to tax court. Um, I wanted to say a quick thing about your self-directed IRA companies changing hands and your IRA being moved. I had a lady come in, her husband died. She got correspondence from the IRS that she did not report. I think it was, let's say, $500,000 in a withdrawal from an IRA made by her husband before he died. And we were down to the wire. The only option was to file in tax court. It's the only time I've ever filed a tax court case to avoid losing rights to contest this issue. The man put money in a self-directed IRA, had the self-directed IRA direct that money in a loan to a guy who disappeared. So the money was gone, the IRA was zero value, but you can't deduct losses in an IRA. But what happened was the company did not get their annual fee. Chris mentioned the annual fees for self-directed IRAs. So they closed the account and reported the original 500,000 as a taxable distribution.
What? Without having a discussion with anyone?
Well, they're happy to discuss it, and there was very little that the IRS was able to be responding to, absent going to tax court. And my understanding is it did finally get settled in her favor. Um, but it was a rocky road because it was years ago. There wasn't any evidence.
Mm.
I got the tax court filed and then turned it to an attorney that specialized in tax court cases. And I think she eventually fired him, but it came out to her satisfaction.
Oh, great.
So
Austin,
every topic on this call is like just scratching the surface. It always
sure,
leads to more in-depth discussion.
it does. Austin, do you have any questions?
No, yeah, this is really fun to listen to these different stories, though. I've heard of things like this, but actually hearing about you put your money with the wrong group and then like things don't work well and hearing what they can actually do, this is very interesting. I appreciate it.
I want,
Great, thank
I
you.
wanted to give a quick thanks to my real friends, Mark, Tino, Kent, Leslie. Looks like Leslie jumped off, but
Mhm.
of the
John,
dozens of people I invited and the dozens that said they would come,
thanks, Jay.
a handful actually made it. Thank you. Thank you.
Tina, do you have any questions?
He has
Thoughts?
a lot of questions, tons,
Good. That's
but
what this is all about, is the Q and
not
A.
necessarily tax related.
Not really, because I've got a really unique tax situation in the sense that I have a startup and so it's I'm yeah, so it's a pretty unique personal situation.
It's a business situation, isn't it?
It is a business situation.
Yeah, okay.
I
Got
want to
it.
give a shout out to Kent. Kent Eigelhart's on the call. Kent recently became a C-Tech, so he is now authorized to prepare tax returns. Um, and and there he is, and live and in person.
Yeah, you have any questions? Now's a great time to ask a CPA.
Boy, so many different
Free.
things to discuss. I'm just listening. I think sounds like really good presentation so far.
Thank you.
Great, thank you. Yeah, so none of this, I mean, the list is long, so I thought it was not long, that just like all the, I didn't think of some of these questions, but one of the questions that I would always ask a CPA is, what is your 1031 skills? You know, how many have you done in the past? And uh, when do you start talking to somebody about them doing their 1031? Because we advise anybody going into a 1031, when they think that they're going to sell, that's the time to start looking for your replacement property. So you don't want to wait until you close. We just had somebody do that, and I suggested months before he even listed to start looking. He's like, no, no, no. I'm like, yeah, now is the time. So it goes, well, I don't know how much money exactly I have coming out. And I said, well, it doesn't matter. We could talk about that, but let's find what you want to replace with. And no, he ended up going into a DST with a very, not such a good return, because he didn't take my advice. Let's just put it
Yeah,
that way.
I wanted to make a comment. If you don't get prepped, the rules for 1031 are kind of persnickety and they're tricky, and you got to be ready. And that DST, Deferred Sales Trust, is a scheme that has been vetted, uh, but it essentially involves a third party
Mhm.
giving you an installment sale and spreading your gain over years, but it means they're going to manage that money for 10 years.
And
So,
take a 2% off
yeah,
of
yeah,
cash flow.
yeah.
Yeah.
Yeah. So if it sounds too good to be true, a lot of jazzy ideas, TikTok, Instagram, many new players in the game. They give great video, very exciting. But beware, just beware. I wanted to hear from Mark Keener. Mark's a very long time investment in the real estate investor, primarily residential, some commercial. Uh, and we've known each other since Arthur Anderson, 1982.
Wow. You guys go way back. Mark, you have a question or a comment at all? We're so happy you're here.
He might have stepped away for a glass of wine. I don't know.
How about Raz? Raz, you have any? We always like everybody to participate. and
He's at
ask
the
a question
airport.
or two.
Yeah.
Oh, yeah, he was at the airport, so he might be driving home. Or getting on he's got a board, so maybe he's already on the plane or whatever. So thank
Well,
you
I
for
had one,
being
one
here.
question. Maybe Michael can walk through the basic transfer from the IRA to the Roth, just the standard way to do it.
Well, it's called recharacterization. It's not complicated, um, but it has to be done thoughtfully. And so and here's another story. I had a traditional IRA at Wells Fargo. I wanted to recharacterize it as a Roth. There was north of $70,000 in the account. It was partially money that was a rollover from a 401k, and the other account was one that we built up by making non-deductible traditional IRA contributions. I went in at year end, and the typical retail bankers are not equipped to handle special requests. And I wanted this recharacterized before year end. We were in there on the 30th, and they reported the recharacterization in the following year.
Yeah, got that.
So
Jay has a question.
to Peggy's point about the multi-year, if you're going to recharacterize and you're going to take taxable IRA money and move it to the Roth, you
Roll.
want to plan it out and pull it out as such time as to minimize the tax bite, because it's paying the tax sooner than you absolutely had to. And sometimes nowadays that's a good idea. It could be a good idea for you. Can't speak for anybody on the call.
But we like to use the word roll because you never touch the money. It goes from your traditional, and it's handled by the two companies or the same company if they have both. Jay had a question or a comment. Ms. Miller?
Yes, thank you. Well, I thought I should take advantage of the opportunity that Peggy has brought you here, Mick. And we do commercial alternative investments and tech, but that's not part of this conversation. And some people have they don't like 1031s per se, and maybe that's for a specific reason. And people are coming to you at this time of year. So it's great that you're even here and not serving clients this time of the year. So it's great to have you. So my question is, it's about like for some people, it's a mental and emotional bandwidth of what they can handle during any one given month with the holidays and tax reductions. So sometimes people realize they need to buy something and they need to invest in something. And do they ask your advice? I guess that's question number one. And number two is, what two sides of the opinion have you encountered on 1031 exchanges, the upside and downside?
Okay, two great questions. Thank you. Yes, you can get in a panic at year end. You've had a great year. You might have figured out that there's a big tax bill due. You may or may not still have any cash to pay the bill. I found the IRS to be generous and very good service-oriented people. And not every tax bill has to be paid exactly when due, but be careful, be careful, be careful. So getting ahead of it is the important thing. As Peggy was talking about, when you begin to anticipate selling is a good time to think about your options, whether you're going to do a 1031 or not. Now, the main thing about 1031 is you're going to stay invested in property. It's called a like-kind exchange. So if your objective is you're moving out of a property or properties and moving into maybe a better class of property or a more expensive piece of property, just a different property. I had a gal, she started her real estate investing in some of the worst parts of Oakland and really got a hard education on landlord tenant issues, gangsters, vandalism, squatters, tenant problems. And So 1031, just get out ahead of it because the rules are pretty exacting. There are facilitators. Originally, it was I swap my property with yours, and there could be cash or no cash. Nowadays, there's professionals, just like self-directed IRA providers. There's 1031 facilitators that will manage the transaction to see that both sides, all the legs get properly dealt with. The thing to worry about for me is people get panicked about creating a tax deduction. Buy something is the word you used. You can't really buy real estate at year end and expect to get much of a tax benefit. It's a long-term play. And one year I bought a new car on December 30th. I used it exclusively for business for 48 hours. And with accelerated depreciation, I got a big fat tax break. People also, I see Marcy laughing. I also, if you're in business and you're at year end, it's a good time if you need, I don't know, computers don't cost enough anymore to get a big tax bang unless you're buying, a room full of servers. Oil and gas investments are a terrific upfront tax deduction. You mentioned alternatives. There are alternatives, but I don't think this is the time and place to go too much into other extreme options to avoid a tax bill. And sometimes the answer is, don't do the exchange, pay your tax bill, and move on.
Well,
So,
it depends, doesn't it?
did I get both questions? I'm not sure.
Yeah, and you also bring up the topic of, okay, if they can't do anything, like I said, sometimes they just don't have the emotional or mental bandwidth to make a decision, even if they need to do something with everything happening at the holidays and they're talking to you to reduce their taxes. They don't know what kind of suggestions you can offer, or they don't ask. So if they don't do anything and they have actually paid their taxes, I suppose there's certain categories where they can just amend or, a return, because I heard when you start a business, and this is from someone in the UK, but he said it happens pretty much everywhere. If you go into business and everything you invested up until the time you created that business, you can get a retroactive credit for it. But that's just one thing. But I'm just saying the point in response to what you just said is they can potentially amend their tax return to account for any action they might take during the month or during that year.
Yes, so 2 points there. If you don't have your books and records sorted out by April, you can extend. It doesn't extend the amount of time to pay the tax. So taxes should be paid timely. The penalties are based on unpaid tax. So whether that's done in April or October, and if you make a mistake or you need to fix it or you didn't get it 100% right, you can amend the return to correct the numbers. But the actions themselves, any real tax impact has to be done within the calendar year that we're talking about. And to your point, December is not the time to start this conversation. I mean, it's not that it's too late, but and if nothing else, you find out where you're going to be. I mentioned this CPA that passed away, and I sat with his bookkeeper and I said, look, there's no reason why we can't wrap up the books for 2024 because we don't exactly know what your tax bill was for your husband's practice for the current year. We think we've paid in enough. We don't know until you do the books. And since he passed in August, by now, there's no reason not to finish up those books or last month or the month before to be straight on. So the point here is really stay on top of books and records, look at options well in advance because in the holidays, the taxpayers preoccupied and the tax preparers are also preoccupied, and the options become more and more limited the closer you get to December 31st if you're going to do any kind of mitigation of a tax bill for the current year.
No, thank you for the clarification. And I just, they, let's say, just hypothetically, they do pay their taxes. They just want to understand what they can claim as an adjustment afterwards if they invested it a lot of money into something they did have to, in fact, have to pay taxes on. But they can retroactively claim a deduction if they open a new entity in the next year, for example, or anything to that effect.
Well, nothing comes to mind that I could do next year to impact my tax bill for the current year, except if I started a successful business that was operated as a sole proprietorship, you can take a SEP deduction, SEP, up to about 25% of the profits of your business. And that does not have to get funded until October of the following year. So successfully self-employed individuals that aren't incorporated can make it's SEP, self-employed pension. It's similar to an IRA, but the limit on how much you can deduct is up to 25%. So say you started a business this year and it went fantastic, and you come to the end of the year and your net profit after all your deductions that you can possibly think of, and some you made up, the net income is 100,000. You can put away 25,000, take it as a deduction in this year on your tax return that you file next year, and you don't have to put the money in to a SEP account until the following year. And similarly, if you qualify for a deductible IRA deduction, that is not due until April 15th. So if your situation, you don't have a company pension or a 401k, and you have earned income, current deduction $7,000, you have until April to fund it and get the deduction for the prior year.
Right. So we still have one more question. We are past the top of the hour. So thank you for your questions, Jay. Always brilliant. Austin, what you got for Mike?
Yeah, so Mike, you're talking about a 1031 exchange. How did they ruin it? Did they submit it too early or did they submit it the following year? I missed how they ruined that for you.
I've not been involved in too many 1031s, and none of them closely. I think what I referenced is if you sold a property and you don't have a replacement property lined up to do it properly, usually through a facilitator, then some of these other options come up, like Peggy mentioned, a DST or deferred sales trust. It's like, oh, you messed up. Have we got a solution for you?
Yeah.
And they can do it fast and they can fix it, but it isn't necessarily in your best interest always. Might be right for some. It makes
Gotcha.
sense for certain, but I had to recommend it to a guy, he's 91 years old. Do we want to put him in a program that's going to take 10 years to wrap up? No.
No, but they could invest passive and then that could be distributed to whoever he leaves in his will. So he avoids the taxes, but the kids get whoever gets the step up on it.
You said will, you meant living trust.
Yes, I did mean
Probate is the
trust. Always
biggest-
trust.
Probate is the biggest crime.
Awful, awful.
Yeah.
Yeah. Yes. It was a longer 4 letters to 5 letters. Okay. Like that. So any other questions? We are at the top of the hour. And I want to thank everyone for being here. This was a really wonderful presentation, Mike. We really, really, really appreciate it. And stick around if you have another question.